Hello, I'm Vadani Ariam. This video about accounting for inventory. Learning about inventory is essential for any business that sells products because you need to buy to sell goods and necessary to have a count of the items that you hold in your business. If not, you might run or overstock the goals. Inventory means that the goods are bought for sales or used in manufacturing the products. It says as the current assets in the balance sheet of a company. Inventory can create cash flow problems because you have used too much to buy the merchandise. Here in the above illustration, you might think it is easy to account for the sale items you have in your stock, but when making the sale, you need to have profit. So the sales figure is more than the cost of the stock. When preparing the profit and loss account, the cost of goods sold taken away from the sales gives you the gross profit. When the cost of goods sold is calculated to deduct from the sales, the additional expenses incurred in buying the inventory are added to the cost of goods sold. There are four accounts involved in the inventory: purchase, sales, return inwards, return outwards. Let us assume a business is buying a stock for $100 and shipping cost for that is $5 and recorded in the inventory account. In addition, when the business sells the book, the amount will be $105, which will remove from the inventory account. Inventory is generally categorized as raw materials, work in progress, finished goods. Raw materials are unprocessed goods used to produce a good. Cost of goods sold. Cost of goods sold to customers are reported on the profit and loss accounts when the income revenue reported. Total revenue taken off the price of goods sold gives you the gross profit for a certain period. Accounting transactions. When preparing monthly or quarterly income statements, the amount of revenue is recorded at the top of the income statement. Cost of goods sold, then subtracted to show the gross profit. When you sell goods you recognize the inventory reduction as well. If your accounting method shows $20,000 and your prior inventory level was $100,000, your new inventory balance would be $80,000. When you acquire new inventory, you add the acquisition cost to the value of the stock. Purchase of inventory. The Nursery accounting entries are shown, I think, above. When a company purchases inventory, makes an immediate cash payment or buys on credit terms. When you make immediate payment, your inventory credit to the bank shows a decrease in the assets, decrease in the cash balance. That's an asset. Credit purchase. When you buy on credit, you will debit the credit purchases and credit the creditor's account. In this case, the liability increases because the purchase is credited to the creditor's accounts. Sales of inventory. In March, the company sells inventory for cash. Therefore, accounting entries will be cash sales credit and the bank debit. The cash goes into the bank. Credit sales. Then the debtor will be credited and sales will be credited and the debtor will be debited. Because sales is an income is a credit account. Income goes to the credit account and the debtor goes to the debit account. In cash sales, the immediate payment occurs, so an asset increases the bank balance. However, payment is received later. Therefore, an asset increase, that is debtors, as we debit the debtor. There is either cash sales or credit sales. There will be an increase in the asset. Then there will be an inventory returns outwards and inwards. So the accounting entries are made in the asset account. That's how asset account, when the inventory returns inward return, the inventory increases. When it goes out, it decreases. That's how it works. Thank you very much. I hope you understood this inventory account. It's a bit difficult. You have to read it again and again to understand. Thank you very much for watching this video. Hope you like it. Please see you in the next lecture as well. Thank you very much for watching my video. Thank you. Bye for now. Talk soon.